Hey everybody, my name is Alex Merced from alexmerced.com. This is my second in my video series on derivatives. In this video I want to talk about derivatives that are created to offset risk. Okay, investments have risks. When you buy a bond, when you buy stocks, you're taking on different risks. And the problem is, risk can sometimes scare people away from making investments. So kind of like when you drive your car, you take risk. You have a risk that you can lose everything if you crash in a car and you're at fault and you can get sued for everything. That's why you buy car insurance. By minimizing that risk, you're more willing to go drive on the roads. And because of that, you're more willing to go drive to work, go drive to the movies. It allows the economy to kind of, function because those risks have been mitigated. And the fact that you've paid for that insurance makes you care about those risks. Because, if you get into a car accident, car insurance will cost more. So I want to avoid getting into a car accident. So insurance helps us mitigate risks that prevent us from, the economy from functioning. And the pricing of that risk helps us, give us an incentive to not maximize those risks and minimize them, which is why insurance markets are so important. Now, in financial derivatives that deal with risk, for like stocks, are something called options, okay? And what options are is you are entering, it's kind of like buying car insurance. So, for example, you buy car insurance when you're worried about your car crashing. If I buy stock and I'm worried about the stock dropping, I can buy something called a put option that locks me in a price to sell. So I buy a put option that has a strike price of 50. If the stock that I bought drops to 0, I can use my put to sell that stock for 50 and I personally won't lose money because whoever sold me that contract, think of them as an insurance company, is really just another investor. They're willing to take the loss for me. But they didn't sell it to me because they wanted to take the loss. They sold it to me because they thought the stock wouldn't have dropped, etc. So derivatives are always contracts between two parties. One party is trying to offset a risk that they have. The other party doesn't think that risk is really a problem, so they're willing to say, hey, if that does happen, I'll take the problem. Options are one example of that. Another example of that is futures. Okay, so if I'm a gold miner and I'm worried about the gold price dropping before I have a chance to sell my gold, I can go short a gold future. So that way I lock in the price of gold. Now the benefit of this, it allows gold miners to offset those risks of the price of gold changing, so that way they can manage their business. It allows the jeweler who's worried about the price of gold increasing to offset their risk and manage their business. Now the problem is, there may not be enough people to enter these contracts with. This is where speculators come in. Speculators provide the ability to find someone to be the other side of that insurance contract, and it provides us liquidity. So I can buy and sell futures contracts when need be because you have all these extra buyers and sellers who are just doing it out of financial gain, but they're providing me more people to be the other side of my insurance. Same thing in options. So people who are truly placing bets, they're providing liquidity to actual economic actors who are offsetting risk so that way they can do more business, start more jewelry stores, start more gold mining outfits, offset the risks in your mutual fund. So that way you don't have to take losses in your mutual fund because some speculator out there is willing to take the other side of that bet. Okay, so they're offsetting risks. That's a good thing, okay? Because since investors can offset their risk, there's more investors because they feel more comfortable investing because they know there's avenues to insure themselves. That's a good thing. That means more capital for more companies. It allows all sorts of economic actors, businesses and whatnot, to offset their risks in different ways, whether it's in the commodities prices or changes in interest rates through interest rate options and futures, to offset those risks so that way they can manage their costs better and run their businesses better, and thus they grow their businesses more because they're not worried about as much unpredictability, as much uncertainty, because these financial products allow them to control costs, control risks, etc., because somebody else is willing to take the other side. Okay? That's a good thing that serves a very strong economic purpose. Again, same reason why you buy your car insurance, because it makes you feel much more comfortable go driving the roads. The same reason you buy any insurance contract you buy. It makes you feel a little bit more certainty, and you're willing to take more action for it. And that's a good thing for the economy. So my name is Alex Merced. I'll see you guys in the next video where I'll talk about more credit-based derivatives. See ya.